Okay, so we are still in Module 6 under the financial statement analysis. So we are now in the second types of ratios, which is called the activity ratios. Okay, so here, when we say activity ratios, the result of this analysis will give us the measure of the liquidity of the specific assets and efficiency in managing those assets, such as accounts receivable, inventory, and our fixed assets. Okay, so if you could still remember, under the liquidity ratio, we focused more on the current assets. Okay, but in this case, we also include, okay, in our uh, data or the analysis, the fixed assets or the non-current assets. Okay, so for this ratio, so we have the following. Okay, so the first type of ratio that we will discuss is about the receivable turnover. Okay, so again, we only focus on under this ratio, we focus more on the accounts receivable, inventory, and fixed assets. So that's why under this ratio, our first analysis will be about the receivable turnover. Okay, so for this one, the result of the receivable turnover will give us the information about the measure of the efficiency to collect the amount due from those credit customers. Okay, so you already know that for a certain entity, they allow credits, or uh, they allow customers, okay, to pay their orders or purchase after a certain period of time. Okay, so this is of course to stimulate or to increase the sales. Okay, so because if you are the customers, it is beneficial and it is an advantage for you if you will be given a credit period, right? Because you have the time to uh, collect and uh, take some time to uh, make use of your current cash, okay, for other purposes. And when the time comes that your is due, okay, so you should be able also, or you have to make sure that you should be able to pay as well. Okay, but the point here is that the customers is not required to pay the cash outright, okay, upon the receipt, okay, of their purchase. So this is the case, okay, that creates our accounts receivable. Okay, so under the receivable turnover, so we have this formula. Okay, this is how to solve this ratio. Okay, so receivable turnover is equal to our net credit sales, okay, divided by the average trade receivable. When we say net credit sales, meaning to say from the sales figure, you only have to get the figure from the credit sales. Okay, because from the sales figure, there might be cash sales, okay, that is included. But again, under the receivable turnover, we will only take the net credit sales. Net because we will deduct the sales, returns, and allowances plus the discounts, okay, taken by the customers. So this is our net credit sales. How about your average trade receivable? How to solve this one? Okay, so this is how you are going to solve for it. To get the figure for your average trade receivable, all you have to do is to add your beginning trade receivable with your ending trade receivable. And then we divide it by 2. So this figure right here will become our denominator to determine the receivable turnover. So this one, the idea here is your receivable turnover should be uh, more frequent. Okay, meaning to say, there is a lesser number of days that you will uh, wait, okay, so that you can collect your receivable. So, for example, if our credit sales here is 100 and the average trade receivable is, okay, for example, we will have it 50. Okay, so the answer would be 2. So meaning to say, in 1 year you only collect twice. Okay, so this is not a good indicator because you have to wait for 6 months before you can actually collect the receivable. Okay, so the idea here, or the ideal figure, should be higher turnover. Meaning to say, for example, if your sales or trade receivable, instead of 50, okay, so we will make it as 20. Okay, so meaning to say your turnover is 5. So this means that every year, okay, if this is for 1 year, every year you are collecting 5 times. Okay, so you divide it by the number of days or by the number of months. Okay, again, the more frequent a receivable turnover is, the better for the company because they can collect their receivables within a shorter period of time. This is the idea of our receivable turnover. Okay, so that's how it works. Okay, so they will determine how fast they are collecting, okay, their receivable using this analysis. Okay, so next, what about this one, average collection period? So this ratio actually is related to the receivable turnover. Here, we uh, determine the number of days exactly. How many days would the entity wait, okay, before they can collect their current or receivables, I mean. So this uh, ratio approximates the number of days it takes a business to collect its receivable from their credit or account sales or customers. So the formula for the average collection period is 360 days, meaning to say for 1 year, okay, divided by our receivable turnover. So, for example, if you will take the 5, okay, before in our previous illustration, if our receivable turnover is 5, okay, so the average collection period will be, so 360 divided by 5, that's 72 days. Okay, so that's more than 2 months. Okay, so mean to say, the entity will wait for more than 2 months, or to be exact, 72 days before they can collect their receivables. Okay, so that's how long they have to wait. So therefore, again, uh, just like what we have discussed in our receivable turnover, the higher the receivable turnover, the better, because there will be shorter number of days that they will wait, okay, to collect their receivables. Okay. So what about, for example, if our turnover is uh 20 20, for example, 20. Okay, so how much will be, or how many days will it take for the entity to wait? It's 18 days. Okay, that's better. So you see the difference. So under this one, they have higher turnover. So therefore, it will take only 18 days or shorter period of time for the entity to wait for them to collect their receivables. Okay, so again, This will help the management to determine how efficient they are in terms of collection, okay, or collecting their accounts receivable. Okay, so the next activity ratio that we will discuss is the inventory turnover. So just like our receivable, our inventory also is being sold. Okay, we sell it, and then we can sell it for cash or for credit, and then eventually turn it into cash, and then we will buy the cash that we collected, okay, from the sales to purchase for the inventory and so on. This is the cycle. But here, uh, what we can get, or the information that we can get from this ratio, is that how uh, fast also, okay, the management is in selling the inventory or converting inventory into cash. So for inventory turnover, this measures the number of times a company's inventory is sold and replaced during the year. Okay, or just like what we have mentioned earlier, how efficient the management is, okay, in converting their inventory into cash and purchasing another inventory and so on. Okay. So for this one, our formula is for the inventory turnover. So this is cost of goods sold divided by the average inventory. So your cost of goods sold, we can take this figure from our income statement. Okay, if you could still remember. So average inventory, just like our average receivables in the previous ratio. So all you have to do is to add your beginning inventory with your ending inventory, and then we will divide it by 2. So this will now become our denominator. Okay, so this is for our inventory turnover. Okay, so here, okay, if we will take this example, okay, so if you will also make this as 100, okay, and our inventory or average inventory, for example, is 50. So your inventory turnover is equal to 2 times. So in a year, you only convert inventory into cash twice. Okay, so just like our accounts receivable, the higher the inventory turnover, the better. Okay, because meaning to say, if this figure right here is higher, so meaning to say you are selling very fast. Okay, there is frequent um, sales. Okay, that occurs, okay, in the company. So that's better. Unlike for this one, we only have an inventory turnover of 2. So this is very slow. Okay, this is not a good indication. Okay. So again, they have the same concept of that of the receivable turnover. Okay. This one also is the same with that of the average collection period. Okay. The sales or average sales period. Average sales period is the average time to convert inventory into sales. So again, this is the number of days. How many days does the company wait before they can sell their inventory? Okay, so we will take also the example. Okay, so by the way, the formula is to solve for the average sales period. This is 360 days divided by your inventory turnover. So for example, if our inventory turnover is 2, okay, so the average collection or average sales period is only, or the company will wait for every 100 days. For every 100 days, that is the time that they can sell their inventory. So it's very long. Okay, it's like 4 months. Every 4 months, you only have a sales every 4 months. Okay, just imagine this indicates a very lack of or they are inefficient. I mean, okay, in terms of sales. So again, the objective here is to have a higher inventory turnover. Okay, so for example, if we have inventory turnover of 30, okay, 30. So how many days would the company have their sales? So in this case, every 12 days. Okay, or the better is every day. Okay, turnover is 360 also. So that means to say every day they have their sales. Okay, so that is the idea under our average sales period. Okay, and the last ratio under the activity ratio is our working capital. So working capital, this measures the short-term liquidity of the company. Okay, so here our formula is just to deduct from your current assets your current liabilities. If you could see this, if we will analyze this working capital, it's like solving for your equity or um, owner's equity, correct? Current assets minus current liabilities is equal to equity. Okay, assets, total assets, meaning to say total current plus non-current assets, as well as your liabilities. But this one, we focus only on the current assets and current liabilities for working capital. So this is just to determine if we have an excess or if the current liabilities is greater than that of your current liabilities, so that the company is able to pay for their obligations when they fall due, okay, if they are liquid. Okay, this is the purpose of your working capital. Okay, so that's all under activity ratios.